If you're older than 40, you might think it's too late to invest in the stock market. You're probably worried there's not enough time to make the profit you need before retirement, and that it's not worth risking the money you do have in case the market crashes. But over the last 10 plus years, I've helped investors young and old navigate through market crashes to generate consistent profit using two simple indicators. Our members have doubled their accounts over the last 2 years using this same system. This isn't theory, this is actual execution. You don't need to be an expert or have any experience of investing, as anyone can use and apply what I'm going to share. In fact, being a blank canvas is often an advantage. You've just got to be open to learning and wanting to do things properly. I want to help you steady the ship and get it on a direct and unwavering course towards your wealth and retirement goals. So money isn't an issue and you're comfortably able to look after your family financially when the work stops. A problem that stops most people from starting is thinking investing involves looking at spreadsheets, formulas, and financial jargon. If maths was never your thing, you probably feel like the stock market just isn't for you. So you keep delaying and avoiding giving it a try because the fear isn't just losing money, it's feeling dumb while doing it. And I absolutely get that. You worry about making mistakes without anyone to guide you, and you worry the so-called gurus will take your money while offering courses that don't deliver or teaching skills, well, they actually haven't really mastered themselves. Warren Buffett will go down as an investing legend. He has cemented his place in history. He retired in 2025. His focus was on a company's fundamentals by analyzing financial statements, earnings, profitability, valuation, among other factors. Since you don't have access to his exact methods, your analysis will differ, leading to different stock choices, and the best part, unlocking superior returns that were once out of reach. I know this can feel overwhelming. I've been there. When I started investing over 10 years ago, the only things I knew about the stock market were stock tickers scrolling on financial TV channels, which really made no sense to me anyway, and scenes from movies like Wall Street showing traders yelling in the stock exchange. Now, you don't need to be good at maths or be a first cousin of Warren Buffett or know some insider trading secrets in order to start making money for your retirement. You just need to know how to use two effective indicators, which I use all the time and that I'm going to cover in depth later in this video. Okay, so this is the chart of Cencora, and you can see at the start of 2022, this was the beginning of this massive uptrend. And when I first entered into Cencora, and this has delivered over 15% of profit into my portfolio. All I needed to understand to enter into this stock was if it's had a performance history where it's continued rising to the upside. And we can see that Cencora, going back to 2010 to 2015, it rose from around $25 through to the high of just over $100 in 2015. So that's a significant move to the upside and a very clean linear trend as well. So when Cencora broke out from this sideways market, which was my trigger that this is the start of the next uptrend, the fact that it had performed well in the past was a very good indication that it was going to perform well in the future. And Cencora, as already mentioned, has delivered excellent profit. Another example is Amphenol. And if we go back to between 2020 and 2021, we can see that the stock climbed around 180%. That is all I needed to know to consider Amphenol as a potential for the portfolio. All I needed was the entry point, and the entry was confirmed in November, December 2023 when it started breaking out from this sideways market. And from that moment, which was around $44, the stock has gone on to climb around 240%. As you can see, the entry was objective, requiring no thinking, and something that you can absolutely do as well. You just need to be able to follow a simple system, which is how I catch big moves in stocks like Amphenol. I didn't use anything fancy. In fact, this move went on to add 23% of profit to my portfolio. We've outlined the phases to replicate this in our stock market blueprint, a tool our community and I use every week to find those stocks that rise 80% and more. I put the link for you to download the blueprint below. Now, spotting that move was simple, but with over 20,000 US stocks to choose from, how do you know what to buy? You're asking around, trying to figure out what the best buying opportunities are. Your friend at work says Tesla. Your brother-in-law swears by Nvidia. Your plumber, well, he says crypto is making a comeback. The point is, everyone's got a hot tip, but crucially, none of them are investors. So the real question isn't what's everyone buying, it's what's worth buying right now before the crowd piles in. Here's the hard truth most new investors miss. By the time a stock is all over the news, the big move has likely already happened. And FOMO is real. You see it going up and you think to yourself, well, I don't want to miss this one too. But buying late is like showing up to the party after the music stopped and the pizza's gone. Rule of thumb, if your mother's cousin's nephew's aunt is talking about the stock, it's probably too late. Stocks that get the loudest attention tend to burn out the fastest. Here are examples of stocks that we have invested in that are yet to gain wide attention. This is unbelievable. The first stock we will look at is Curtiss-Wright. We first highlighted our scanner first highlighted Curtiss-Wright back in 23 at around $200 when it had broken out from this sideways market. We can see that it has gone on to climb significantly by around 215%. So a big move to the upside. Another example is Seagate Technologies. Our scanner highlighted Seagate Technologies halfway through 2025 when it broke out of this sideways market, and we can see that it has gone on to climb around 175% since that breakout. So again, a very profitable stock that has gained no mainstream media attention. You want to buy stocks that simply haven't taken off yet. The ones that are at the start of their bullish move will exponentially grow your account in a short period of time. Now, later in this video, I'll walk you through 2 simple indicators that will help you time those entries with precision, so you stop guessing and start catching real moves before the crowd even notices, if they notice at all. But here's the trap. Buying is the easy part. What really kills your gains is not knowing when to get out. You even start doubting your own judgment because every exit feels like you're selling one of your best friends. You hold on to winners too long and watch the gains disappear. You get scared when a stock shows signs of volatility and sell at the worst possible time, right before the rebound. Or worse, you never sell and end up with a portfolio full of deadweight stocks that keep falling. Basically, there's no clear playbook, and the fear of making the wrong call keeps you stuck. What you can do is use a Donchian level. This marks out the low over a number of days. We set it to 20, so this will mark out the lowest point over the last 20 days. This is key because it signifies a strong support level that, if it gets broken, tells us the stock is likely to keep falling. So if the price breaches this level, then you want to get out. This stop loss tool follows the stock as its price rises. If the price drops significantly and falls below the lowest point from the last 20 trading days, the tool triggers an exit. This helps you quickly exit a losing investment and secures profits on a strong investment by locking in gains as the price climbs. So let's have a look at an example on the charts. This is the daily chart of Amphenol, which is where I like to apply my Donchian levels. And if we go to the beginning of this massive uptrend, which was in April, May, June of 2025, we started entering into Amphenol around May, June of 2025. And you can see that it has been walking along the upper band of the Donchian channel. So the green line is the upper Donchian channel and the red line is the lower Donchian channel. So that lower part of the Donchian channel, this is our trailing stop loss or our exit management. As long as it stays well clear of this red line, we simply hold onto our investment. So a strong trend is one that hugs the upper Donchian channel, which Amphenol did all the way through from April of 2025 through to this high point here in November of 2025. So a really clean, strong uptrend. It was at this high, we then saw a pullback a sideways market, and we then had this first close in December of 2025 below the Donchian channel. Now, depending on whether you are an aggressive investor or a more conservative investor would have exited on that first close below the Donchian channel. Maybe your trading plan could say 2 closes just to give it a little bit more space. If you waited for a second close, you would have seen that the reversal came back in and the trend continued moving to the upside. But in short, this is a very, very good example of how to use a Donchian channel as an exit management system, an objective exit management system that removes the guesswork, protects your downside with clear exit levels, but also allows strong trends to continue to the upside so you don't exit too early. A Donchian channel will have you investing safely since your downside is capped. But what happens when the headlines are screaming recession? Stocks are dropping, and if you're over 40, well, that fear hits differently because you don't have 30 years to ride it out. But even during a bear market, smart money investors know how to turn a profit. We did it during the last major crash. But the good news, even during a bear market, smart money investors know how to turn a profit. We did it during the last major crash. So before I got into investing, I watched the 2000 tech bubble market crash unfold on the news. Companies and stocks were getting wiped out overnight, and the S&P 500 fell 50% for the following 2 years. A popular Warren Buffett quote is, "Be fearful when others are greedy, and greedy when others are fearful." And I remember this quote when I was investing during the global financial crisis market crash between 2007 and 2009, when the S&P 500 fell 57%. While others were fearful and running as far away from the market, I was shorting the market. I learned from the 2000 market crash that there were losers and there were winners, and I chose to be part of the winners. Shorting is where you make money during a down market. You do this by borrowing a stock to sell it at its current price, let's say $100. Then you wait for the value to decline and then buy it back at the new low price, which is, let's say, $35. You then give the stock back to the owner and keep the difference, which for this example is $65 of profit. I shorted stocks like AIZ, ALL, AMP, and AXP because I saw a clear shift in the pattern they were making. So let's have a look at an example of a bear trend on the charts. Here we have the monthly time frame for ALL, that's Allstate Corporation, one of the stocks that we shorted. And if we go back to 2000, which is this low point here, we can see that it was quite clearly in this long-term bullish trend. And we know that because it was making a series of higher highs and then a series of higher lows, which is part and parcel of a bull trend structure. We then went through a sideways period or a top here, and then the trend structure changed, and it changed to a series of lower lows and lower highs, which is the signature of a bear trend. And we can see that continued all the way through to the low of 2009. So when we saw that structure change from higher highs and higher lows to lower lows and lower highs, we knew that the trend structure had changed and we moved from taking long positions to shorting the market during that bear trend. Then we saw a reversal back to the upside and a sideways period. This was our sign that the bear market had come to an end. And we can see that from that 2011 low, Allstate has been on this massive climb to the upside. So once you're making consistent profit, you need to know how much to make a year to reach your financial goals. To do that, well, we need to account for your age and financial situation. Most people don't know how much profit they need to make, so they just throw money at the market and hope it's enough. Well, that's not a strategy. You need a way to measure your progress. So I want to talk about a few specific scenarios. If you've got a high amount of starting capital, this is how I would think about your investing. Focus on being conservative and only risk a small percentage of your capital, say 0.5% on each investment, because you can afford to and still make your desired amount. If you haven't got so much starting capital, you want to risk slightly higher, but no higher than 2% per investment to increase the growth rate of your portfolio. Let's look at an example. Let's say you have $20,000 as a starting amount, which is a really good starting capital to start investing with, and you want to add a further $100 a month to the pot. You have a 20-year time horizon until retirement, and in that time, you want to turn the $20,000 into a cool $1 million. To do this, you need to be achieving 19.78% a year annually to reach your desired amount. To calculate this, you can simply download our wealth calculator. All you need to do is add your initial investing amount, then the amount you desire at retirement. If you're only adding more money annually, then add the amount, otherwise add your monthly contribution. Lastly, add how many years you have until retirement. Let the calculator work out how much annual percentage returns you need to make. You can then get to work achieving that mark, feeling reassured you will be able to stay on track. This number is unique to you and must be respected. Now that you have your magic wealth number to hand, you need a system to ensure you can hit your annual target to ultimately reach your wealth and retirement goals. These two indicators will make sure you are profiting from stocks that are about to take off, leaving everyone else to catch the FOMO stocks. The first indicator will help you filter out the best stocks early. It tells you when a stock is gathering momentum. The indicator is simple to use, and most investors would have already heard of it and have access to it, but they don't use it correctly. And that is the simple moving averages. The reason it may not have helped you to be consistently profitable is because you are not taught how to use it to catch the big profitable trends. Moving averages help to make us over 30% a year in the stock market, and I'm going to show you how. Here are the two settings you need to pay attention to. The main settings I use are the 200 and the 50 simple moving averages. The reason they work is because it keeps you focused on the longer term view, and that's where the money is made. So let's switch to the charts and have a look at an example. So we're looking at the chart of Amphenol, and you'll see that there are two lines on the chart. The black line is the 200 simple moving average, and the orange line is the 50 simple moving average. Now, the 200 simple moving average is used by the institutions to determine trend direction. When a stock is above it, we are in a bull trend, and when a stock is below it, we are in a bear trend. So we can see at this point here that Amphenol is clearly in a bull trend because it's above the 200 simple moving average. And around this area here, this was the potential early start of a bear trend, but you can see that it failed. It was below the 200 simple moving average. It failed and the stock reversed back above it. So the 200 simple moving average is a very clear marker where we can see bullish trends and bearish trends. Now, we want the stock price to be above the 200 simple moving average on both the weekly and the daily timeframes. Here we're looking at the daily time frame, but to confirm bullish action, we also need it to be above the weekly 200 simple moving average. Okay, and then the 50 simple moving average is also used as an additional filter. This really helps narrow down to the best of the best stocks. A stock might be above the 200 simple moving average, which is the black line, but below the 50 simple moving average. These are stocks that we would not consider. Stocks that make it into our portfolio must be above the 200 simple moving average and the 50 simple moving average on both the daily and the weekly timeframes. So if we look at Amphenol and if we move to this area here, we can see that this clean bullish trend has predominantly remained above the 200 and the 50 simple moving averages. This is from when the trend started in April 2025. It dipped below the 50 simple moving average temporarily here, which may have been a period where you may have considered exiting, but if you stayed in this based on how the exit management was running, we looked at Donchian channels earlier, then we can see that this has continued its trend. Now, the second indicator that we use alongside moving averages is the trend filter. So let's go back into the charts and I'll show you how the trend filter works. Now, we're looking at that same section of Amphenol on the daily time frame that we just looked at earlier, how the trend filter is created. So first of all, I'm going to load up two sets of Bollinger Bands. We've got Bollinger Bands in colored blue, which is set with standard deviation 2. And then we've got Bollinger Bands in the middle, which are based on standard deviation 1. Now, what's good about having 2 Bollinger Bands with these different standard deviation settings is that they create zonal areas. The upper zonal area between the top blue and the top red Bollinger Band, that is your buy zone, or where we have a bullish trend in play. And between the bottom 2 Bollinger Bands, that is your sell zone and where we could potentially have a bearish trend in play. But as we're looking at a bullish example here, we want to see the stock climb between the upper Bollinger Bands. Now, if it moves into the middle zone, that can be considered a consolidation or a sideways market. And if it remains within that middle zone and doesn't break below it, we can assume that the bull trend is going to continue to the upside. Now, it's at this point here where the reversal came into play, where it moved from the upper zone into the lower zone, walked sideways for a period, and then came down and closed below the lower Bollinger Band. And that could potentially be a point where you may exit your position. So you can see a very nice profitable move to the upside where Amphenol is walking through the upper Bollinger Zone, went sideways, dipped below it where you may have exited, and then continued to the upside. Now, instead of having Bollinger Bands on the charts like this, we have developed a trend filter. So if I load up the trend filter, and how that trend filter works is that if it's in that upper zone, the bars will be green. If it comes into the middle zone between the Bollinger Bands, the bars will turn gray. And if at any point the bar closes in the lower Bollinger Zone, then the bars will turn red. And so now that we have this trend filter on the charts, what this allows us to do is remove the 2 Bollinger Bands, giving us a much cleaner chart to look at. So all we're left with is the trend filter, and we can very clearly see the bullish trend in play with the trend filter being predominantly green. Yes, there will be bits of gray during sideways periods, which is absolutely fine. It's only when the trend filter turns red we may be concerned about potentially exiting from this position. Use these 2 crucial indicators to catch the big profitable trends. I've been using them for the past 10 plus years to make an average of over 30% a year. Now that you know how to use these 2 indicators to catch big moves in the market, you're equipped to handle the skills that supercharge my portfolio to consistent profitability. Click this video where I'll walk you through how we look at 3 key time frames to find high probability stocks, which increased my odds of averaging over 30% a year.